Intangible assets, the general rules are they must be capitalized, and then they're expense over the estimated useful life, but only if you can estimate the life. Expensing requirements, you must use amortization. Allocation based, that is your cost minus any estimated residual value. And service life, the useful life also is an estimate. So what are intangibles? Well, they lack physical substance. Now this will exclude financial assets. They represent exclusive rights to the owner. They can be purchased or internally developed, and there are certain ways to value them based on fair value. With internally developed, specific research and development rules apply. Can be finite or infinite lives. It determines and that will determine the accounting treatment. So what are intangibles? Looking at a patent first, it's an exclusive right. It has a 20-year legal life, but you amortize it over the lesser of. If it's a 20-year legal life, but I'm only going to use it 10, I amortize it for 10. And legal expenses to successfully defend. So I own a patent, someone comes along and infringes, I can capitalize my legal costs, but the defendant cannot. Unless it turns out the defendant wins the lawsuit, then that would mean they own the patent, and then they could capitalize the legal expenses. A copyright's an exclusive right given to a published work. Websites will automatically copyright, some limited copyright rules. So the creation of this video and putting this on YouTube is automatically copyrighted. There are some copyright protections for these videos. Is the life of the creator plus 70 years, but that's a long time, so you would amortize it over the lesser of. Always just remember the lesser of rule. Trademark is similar to a trade name. Trademark is exclusive right to display a word or a slogan. Trade name is your name of your business. You cannot amortize an intangible with an infinite life. Now, because a trademark or trade name has unlimited renewals, you really cannot estimate the life unless you know you're not going to renew it. Franchise. We look at franchises in both the assets chapter and the liability chapter. There's a lot to franchises. It's a contractual arrangement granting the franchisee exclusive rights to use a trademark or trade name, and it may include products and merchandise. Advertising, rights to operate in a specific geographic area where the franchisor will not sell another franchise in your area to protect your business income. Now, it usually expires if it's not renewed, and the lives will vary. The initial franchise fee, so I purchase the franchise, I get to capitalize it, and I amortize it over the lesser of, again, legal versus useful life. Then there will be recurring franchise fees that come along. Those have to be expensed as incurred. Goodwill. This is a unique intangible asset. It represents the cost not directly associated with any identifiable rights. What does that mean? It means you can't separate or sold apart from the company. So you cannot just sell your goodwill. It's the value of the company over and above the value of all identifiable assets. So let's say I'm going to buy a company and the appraised value of all the assets is $500 million, but I'm going to pay $600 million. I'm going to pay more because I think it's worth more because of that intangible. That difference is goodwill. And here are some of the examples of what can create goodwill. Now, you cannot record goodwill as an asset because you created it. Goodwill only exists on the balance sheet when you purchase another company for more than the assessed or fair market value of the identifiable assets. You're never allowed to capitalize internally developed goodwill, and that's because it's too subjective. Too much unethical behavior could begin. We could just say something is worth something. The general rules is if it has an indefinite life, you cannot amortize it. You have to know the life to amortize. Always follow the lesser of rule for term. So we're going to look at a goodwill example. Redwood Corporation acquired all the capital stock of Greenwood Corporation for an agreed upon price of $14 million. The book values and fair values of the assets and liabilities acquired are as follows. Okay, so I'm Redwood. I'm buying Greenwood. Greenwood's book values are given. I'm going to pay the fair value of it, plus a little more because I really want it. The book value, remember, is the seller's books. It's given to you. Don't let that confuse you. You're the buyer, not the seller. Your only concern is with the valuation you're going to put this on your books. The purchases should be valued at its fair value. So we're looking at net assets. It's another term for equity. The excess paid over the fair value of those net assets you are acquiring. The net assets are also what's left over after the liabilities, but you're taking on those liabilities too. The goodwill is the additional intangible asset purchase. So first thing is you're buying the company, you've got to create the journal entry. So current assets recorded, PP&E, other assets, current liabilities. Everything up there you're recording, but you don't balance. You paid $14 million. To balance debits equal credits, that's goodwill. That's $4 million. Make sure you check your work. Assets acquired, liabilities acquired, net assets acquired, $10 million. I paid $14 million. Goodwill's fair value. You could plug it or you can use that to double check your work. Goodwill is never amortized. The impairment rules will apply, and what are those impairment rules? Well, that's in a separate video.